Hello, and thank you for joining us today. This is Brian Engel with the Realty Group and the Lock team, and also representing Semler Homes in this video. But I'm joined today with Lee Aldrich in the upper left,
Hello.
and on the bottom center is our star of this video. Actually, it's Earl Rose from Guaranteed Mortgage. And what I wanted to do is really kind of hit on reverse mortgages because I've talked with a number of customers during open houses and actually had some customers buy a home, build a home with us in Semler Homes using a reverse mortgage. And I know the immediate reaction I normally get is, no, I don't want a reverse mortgage because they're going to take my home at the end of this. So I just thought I'd get some experts on, since I'm not one, to speak to that a little bit. And I'm just wondering, guys, if you could, just quickly kind of describe what exactly is a reverse mortgage?
Well, reverse mortgage, the word reverse is what turns a lot of people off, meaning that they think that that word seems to indicate they're going backwards, when actually what it is a backwards statement, but about cash flow. So it's reversing cash flow. Normally you get a conventional, say, 30-year loan, you're going to make a payment. Now you don't. And so that's where the term came from. It's a layman term. The actual official title is home equity conversion mortgage. And what's it's suggesting there is that we're going to be able to take what was normally frozen equity dollars and we're going to be able to convert them. In the case of a refinance, they could use them for assets that they could use in conjunction with already other assets they may have in retirement. In the case of a purchase, they're able to use that asset. For example, say mom and dad sold the house. I'll just make some, mom won't make the number up. I'll use a real one. Mom and dad sold the house and they want to buy a nice townhome. Now, they're not going to go beyond their means because people don't do that. But what they do want to do is they want to have a very comfortable and put some amenities in it, because this very well could be probably their last home. So he's got $335,000 in hand. They could go pay cash. And are they going to pay cash? We have to remember the age group of who we were talking about. These are folks that want to have the cash outlive them.
Yeah.
So we get the 335. We want to cut our payments down. We don't want payments as much as we can avoid. So they're either going to buy a townhome for $335, or they get to buy this other one, which in this case they did, for $592, and still have no payments. But one of the big things that comes about from there is, okay, who owns the home? The people living in it. It's a mortgage. The word mortgage means it's a public notice that I own a piece of property that I put up as collateral for a loan. So therefore, all the mortgage rules apply. The fee simple position of the owner never changes. The bank never owns the property. It stays if the family is there and the mom and dad pass away. The house is then, by virtue of the will or the trust, is then handled by the remainder of who the estate might be. Now, if mom, dad, anyway, I kind of get ahead of myself there, but what does it do? Well, it allows you to buy more home in the case of a purchase than you would otherwise, and it gives you a lot more options with your money, is what it's going to do, while at the same time giving you options with the cash flow that you have remaining for your retirement days.
Great. So let's say somebody's got a home, they're going to sell it. Let's say they net $250 on that deal, and they just want to build a basic townhome. Let's say $280,000 townhome, detached townhome. So how does that process? Walk me through how you would explain that.
Well, first of all, we'd have to determine how much are we going to be able to assist them? How much are we going to give towards the project? And you determine that by the age of the youngest who's on title or going to be on title. So it's the youngest age, it's going to be the value of the home, and then what are current rates? Now those three combined into our algorithms tell us how much of the $280,000 can we give them. I'll give you an example. If it were that they were, let's say they were 62 years old, they're going to have to bring 56, roughly speaking, about 56% of the 280 to the table. The rest would be carried by the reverse mortgage. The older you are, the less you bring to the table. And the reason is the tables, which were originated back in mid 80s, says that you have to be at least 62, and at that time, 100 was considered to be very, very old. Well, still old today, but let's face it, the tables are actually quite old themselves. So the older you are, the less time based on that chart that you're going to be here. Now, you could live to be 120, but we have to use a chart to come up with some mathematical analysis. So the younger you are, the more you bring to the table in the case of a purchase like that. And the older you are, so we'll go the other side. If you're 92, you only have to bring in 34% to the table, as they think you're only going to be there for another 8 years. The fact is that person who buys that at 92, if they did, they could live to 120 and they still wouldn't have any payments. And there would never be, the note doesn't, there's never, you don't have, like with a conventional loan, you say, what's a 30-year loan? There is no end date to this. The end date is when you leave the property.
Okay. And then, so let's say, in an unfortunate situation where someone passes, what happens in that situation?
Well, if there were two people and there was a spouse remaining, then that spouse, as long as they reside in that home, and they only have to stay in that home 1 day short of a year to qualify for it to be the primary home. So it means they could go to Arizona for the winter, no big deal. But as long as that remaining person occupies that property as their primary dwelling, they can stay there as long as they live.
Okay.
Yeah, but I'll touch on this quick. Actually, Earl helped my mom and dad buy their current house with the reverse a few years back. And it was a true, blessing because, my dad had fell into some issues and recently passed away. And the last 2 years, they were 45 miles closer to us. We were able to spend a lot more time with them. And that's exactly what they did. They took a free and clear house that was worth like $130,000 and rolled it into a very nice new construction slab on grade, and were able to move over, from their original house to this house, be closer to us and be a lot more accessible for his condition, and, do that without a house payment. And then just to finalize on that question, when my dad passed away, my mom's already been going through the process, and essentially, that's exactly what Earl's saying. To continue occupying the house, she just has to fill out, a document once a year confirming she's still living there. So it's actually a lot simpler than I thought it could be, and it's been a great process, and truly huge blessing to our family.
Interesting. Wow. Well, thanks for sharing that, and I'm sorry for your loss, Lee. That's
Thank you.
never easy. I know that for sure.
Yep.
Well, Earl, is there ever like a better time? I mean, how do you kind of determine when you do have when a couple has a good opportunity to use the reverse, or maybe when they shouldn't?
There wouldn't be any shouldn't, and the reason I say that is obviously it's designed. When this was created back in the mid-'80s, and it took them 7 years to create it, the whole idea was, again, to extend the dollars as far as they can. So anytime someone looks at this product, you have to look at what their goals are, and that's obviously going to be one of the goals. Leveraging those dollars, in other words, the ones that they have available, so that they don't have to put all the money into the property. Again, we'll go back to that one at $235,000 they have cash in hand, or $335,000 rather. Well, if they were to have bought a property and paid the whole thing down, they too would not have a payment, but they wouldn't have access to that $335,000. Their option would have been, they could have bought less than a $335,000. Maybe they bought it at $335,000 and they only had to come in with, we'll cut that number down and say they only had to come in with $150,000.
Oh, okay.
Well,
gotcha.
So they could have gone either way. It opens up options. It opens up opportunities that they didn't even know existed. Because as a trained consumer, we think in order to own something, we have to make a payment. And if we don't make a payment, there's something wrong with this product. Somebody's got a hook in me someplace.
Yep.
The fact of the matter is, a reverse mortgage operates much like a certificate of deposit in a bank. And by that, I mean this. The pools of monies that are made available for these, and that's what they're actually called. You have insurance companies, people like Warren Buffett, they put money into these pools, and they know that over a certain period of time, those dollars are going to come back to them. Not unlike when you go into the bank and you say, I want to make a certificate of deposit. I'll give you $5,000. I'll come back in 2 years. You'll give me my $5,000 and you'll give me the interest. Well, that's easy. We all know how that works. Well, that's how reverse mortgages look to those investors, because the average life of these loans is 5 to 7 years. And you say, well, I thought you said they could live there forever. They can, but think of the age group. On average, hips go bad. I want to go to Arizona. I'll move closer to the kids. Things change. So on average, they get that money back in 5 to 7 years. And these are insured loans by HUD. So that means even if the economy were to tank, they're going to get their money back. So for the investor, it's a pretty secure thing. And for the borrower, it's the same thing happening. They don't have to worry. And I'll allude to that for a moment, because, you know, in the crisis that we went through, many homes were underwater. Those that had reverse mortgages were underwater due to the economy, not due to the product. HUD stepped in and that family was able to move without having to pay the difference. The insurance paid it.
Nice. That's interesting. Cool. Well, guys, I appreciate your time and the information you shared. As you can see, our contact information is on the screen. So if you want to reach out to us, feel free to do so. I might have to call you, Lee, just to still try to wrap my head around this. And, you know, I think I would encourage people to do the same in the future. So, guys, I appreciate your time, and thanks, and we'll look forward to working with you in the future.
You bet.
Thank you.
Take
Have
care.
a good day.
Yep. Have a good day.